Let's jump right into this explainer. We are looking at a massive, literally unprecedented shift that's reshaping the entire semiconductor industry. And honestly, by extension, it's reshaping everything we do online. If you thought those chip shortages back in the early 2020s were wild, what we're seeing right now in 2026 is just an entirely different beast. We're no longer dealing with a standard market recovery. No, we are watching the actual architecture of our global digital future being built from the ground up. And the stakes, well, they've absolutely never been higher.
The crucial point here, the thing you really need to wrap your head around, is this staggering figure, $8 trillion. That is the projected global AI infrastructure funding flooding into the market from 2025 to 2029. We're talking sovereign wealth funds, massive hyperscalers, and neo-cloud providers all creating this giant multi-source capital engine. This isn't just some temporary spike in tech spending, it's an $8 trillion structural foundation that's fueling an entirely new era of demand for silicon.
Because look, for decades, the semiconductor industry was notoriously cyclical. It was completely driven by boom and bust consumer markets, right? Stuff like PCs and smartphones. But those old rules of volatility are absolutely being rewritten. Today, we've shifted into a sustained structural supercycle. While regular consumer electronics are kind of stabilizing, the real, unstoppable momentum is being driven by the relentless expansion of AI infrastructure, industrial automation, and the fact that EVs, electric vehicles, now make up over 20% of new vehicle sales. And each of those cars requires massively more silicon than older models.
So here's our roadmap for how we're going to unpack this whole ecosystem. First, we'll look at the new AI supercycle. Second, the foundry wars. Third, the memory bottleneck. And finally, some hidden supply chain threats.
Let's start with part one, the new AI supercycle. See, we're moving away from simply training foundational models, just teaching the AI, and we're entering the era of agentic AI. What this means is AI that actually acts, infers, and operates dynamically in real time. In fact, over 85% of AI units from 2025 onward are going to be dedicated to this active inference rather than just training. This shift requires a significantly heavier hardware footprint. It expands context windows and places an exponential load on memory infrastructure. It's totally changing the game on what data centers actually have to buy.
That brings us to part two, Foundry Wars, looking at TSMC versus Intel versus Samsung.
When you look at the current dominators, the numbers are just breathtaking. TSMC holds a staggering 72% of the pure-play foundry market. 72%! They're completely dominating the space, and it's heavily fueled by their accelerating 3nm ramp and just massive expansions in their CoWoS capacity. That's the advanced 3D packaging you absolutely need to stack high-end AI GPUs. It's a level of market concentration that makes it incredibly tough for competitors to even close the gap.
But seriously, do not count out the competitors. Samsung's Device Solutions division just delivered a historic Q1 in 2026. Get this, their operating profits skyrocketed by an astonishing 756% year-over-year. That is huge. They are capturing the AI-driven memory boom perfectly, which now accounts for nearly 94% of their total operating profit. And now they're fighting tooth and nail to regain ground in the pure foundry space, aggressively pushing yield improvements on their 2nm process. They're getting ready to mass-produce NVIDIA's new LPUs, those language processing units designed specifically for these massive AI workloads.
Meanwhile, let's take a look at Intel. They are playing a really strategic long game here. Intel is aggressively locking in multi-year customer agreements because they see AI demand pulling workloads back towards CPU-heavy architectures, specifically for those agentic inference tasks we were just talking about. Their 18A manufacturing yields are actually running ahead of their internal projections, so they're locking in the demand right now to ensure their newly built foundry capacity converts to massive external revenues starting in 2027.
And of course, we absolutely cannot ignore what's happening in China. SMIC, which is China's largest foundry, is running at a near maximum 95.8% utilization rate. They've pushed their capital expenditures way past the $8 billion mark just to keep up with surging customer demand. They are completely offsetting any weakness in low-end consumer chips with massive momentum in localized AI application models and heavy edge inference deployments all across different sectors in China.
Moving on to part three, the memory bottleneck.
The really crucial point here is that AI data centers are literally starving for memory. Historically, compute, like the raw processing power itself, was the main bottleneck. But today, because of those massive agentic AI workloads, memory is the new choke point. Specifically, we're talking about high bandwidth memory, or HBM. Demand projections for HBM are up by more than 40% in 2026 alone.
To keep the AI fed and running, data centers are now having to physically stack memory directly onto the processors. It's wild.
Finally, part 4, hidden supply chain threats. It's pretty fascinating to stop and ask, what could actually derail this $8 trillion AI supercycle? I mean, we are engineering intelligence at an atomic level, but at the end of the day, we're still bound by the laws of physics and global geography.
These are the unseen enemies of the supercycle. First up, helium. It's a non-renewable industrial gas that's incredibly difficult to substitute, and you absolutely need it for wafer cooling and extreme ultraviolet lithography. Those are the lasers used to actually print the chips. And right now, the supply is structurally tight. Second, fragile logistics. Hubs like Dubai are massive transit points for high-value semiconductor components, which makes the whole supply chain super sensitive to any geopolitical disruptions in Middle Eastern airspace. And finally, the biggest threat of all, energy availability.
This perfectly highlights the ultimate irony of the 2026 market. Chip production can actually scale faster than physical infrastructure. Think about it. A new AI server rack consumes 2 to 3 times more power than a traditional one. You can pump billions of dollars into foundries to churn out silicon, but expanding a regional power grid, that takes 3 to 5 years. Delays in securing transmission capacity could literally leave multi-million-dollar AI clusters just sitting in the dark.
So the foundries are ramping up. The memory bottlenecks are being aggressively engineered around, the $8 trillion in capital is flowing, and the silicon itself is ready to go. But as we engineer this incredible new level of intelligence, our biggest hurdle isn't writing the code or printing the chips. Our biggest hurdle might just be plugging it all in. If our electrical grids can't handle the power of our new digital brains, who gets disconnected to keep the AI running? Something to think about. Thanks for joining me for this explainer, and I'll catch you next time.